Okay, let's jump right in. The date is March 4th, 2026. Imagine the scene. $1 trillion market meltdown. Geopolitical chaos is everywhere. And in that kind of panic, there's a desperate flight to safety. Now, in that environment, one asset, silver, was supposed to just absolutely crumble. But here's the thing, it didn't. Today, we are breaking down this silver paradox. This is going to be a rigorous, purely data-driven look at exactly why it held the line.
So this is the big question, right? The central paradox we're digging into. You have extreme fear, you have markets in chaos, and yet silver just held its ground. Now, this wasn't some random fluke. It was a perfect storm of technical, macroeconomic, and crucially physical market factors all coming together to create this incredibly powerful floor under the price. So let's start peeling back the layers of that defense. So our first layer of analysis has to start where all institutional assessment begins, the price chart itself. This is where the algorithms and the big trading desks drew their first line in the sand, and they did it based on some very specific and widely watched technical structures. Now, a critical tool here is something called the 150-period exponential moving average, or the 150 EMA. Just think of it as a dynamic trend line, one that gives a lot more weight to recent prices. For the big funds and the trading algos, this isn't just a squiggly line on a chart, it's a critical decision point. It represents the market's medium-term consensus on value, and it's where they place their big bets. And here is the result. You can see it right there. After a really violent sell-off, the price of silver came down and found a rock-solid floor right at that 150 EMA, right around $83. To see a bounce that precise in such a chaotic market, well, that's a crystal-clear signal of strong, underlying institutional demand. It shows that at this specific level, the big buyers decided the asset was undervalued, and they stepped in with real conviction. So this price action has basically drawn the battle lines for us in the near term. The floor, the support, is clearly established at that 83 level, and the ceiling, the resistance, is that zone up between about $87.20 and $89. For the market to really signal that this is a true reversal, we need to see a decisive close above $86. That would be the sign that the sellers who drove that panic have finally run out of steam. But the strength of silver's technical defense, it wasn't just about its own chart. It was directly fueled by a critical failure over in the currency market. And that brings us to our second layer, the US dollar. Let's walk through this pattern on the US dollar index because it's a textbook move. First, in step one, the dollar pushes above its key January high. Everything looks bullish, like a breakout is happening. But then look at step two. It just completely runs out of gas. It can't hold. And then step three, bam, it slams right back down, closing decisively below that critical level. This is a classic swing failure pattern. It's a textbook bull trap. It catches all the aggressive buyers on the wrong side of the trade and often signals a very sharp reversal is coming. The cause and effect here is direct, and it's really powerful. A surging dollar was the main thing driving the metal's sell-off. So when that surge failed so spectacularly, that headwind just vanished. It gave hard assets like silver, which are priced in dollars, immediate room to breathe. By the way, if you're finding this analysis valuable and you want to stay ahead of these kinds of market-moving trends, just take a second to like, share, and subscribe. It ensures you won't miss any of our future in-depth explainers. Okay, now we get to the third layer, and honestly, this is probably the most critical part of the entire analysis. We're talking about the massive disconnect between the paper price of silver that's traded on financial exchanges and the reality of what's happening in the physical market. This chart just lays it out with stark clarity. I mean, look at this. On the left, you've got the Western paper price, trading around $83 during that sell-off. But over on the right, the physical price in the Shanghai market was telling a completely different story. It was commanding a price equivalent to $95. This isn't just some minor discrepancy. It is a massive structural divide. A $12 premium. Let that sink in for a minute. That tells an incredibly powerful story. While the paper markets were in a total freefall, the actual demand for physical metal in the East was so intense that this huge price gap just stayed there. It persisted. This isn't just a market anomaly, it's a clear signal that the end users and the long-term investors are basically ignoring the paper price and are aggressively securing tangible, physical assets. And we see this exact same story being confirmed when we look at the inventory levels on the COMEX, the big Western exchange. The key number to watch here is registered silver, and it's fallen below 88 million ounces. Now, put simply, this is the silver that is fully available and ready for delivery to any buyers who want the actual metal, not just a paper contract. and that pile is shrinking, which tells you there is a consistent physical drain out of the financial system. The signals from the professional market, where the big institutions play, are even more telling. You see things like elevated lease rates. That just means it's gotten a lot more expensive to borrow physical silver. Then you have deeply negative swap rates, which means big players are willing to pay a significant premium to swap their future claim on silver for physical metal today. You take all these indicators together, and they are screaming one thing. There is a scramble for immediate physical supply among the market's biggest participants. So let's just quickly recap. We've seen a technical price floor hold firm, we've seen a major headwind from the US dollar just evaporate, and we're seeing crystal clear signs of extreme tightness in the physical market. That combination fully explains silver's resilience. But, a rigorous analysis has to consider the other side of the trade. So let's conclude by outlining the 3 core risks to this entire outlook.
First, you could see another coordinated intervention in the paper market or just a severe liquidity crisis in the stock market that forces indiscriminate selling across absolutely everything. Second, if the US dollar somehow reverses course and manages to get a decisive daily close back above its January high, that headwind from metals would return in full force. And finally, a sudden de-escalation of geopolitical tensions, say in Iran, or if the supply situation in Mexico suddenly stabilizes, that could remove the fear premium that's currently priced into the market.
And all of this brings us to the ultimate question at the heart of the silver paradox. When the paper price of an asset becomes so detached from its physical reality, history shows us that something has to give. The question for every single investor right now isn't if this gap will close, but which price is going to move to meet the other. And the answer to that question could make all the difference.